connecting investors, financial institutions, and businesses around the world. Luxembourg is a centre of excellence for global finance. Recognised for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial centre and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to today's live stream, a focus on global competitiveness. Competitiveness. Given the countless challenges that we currently face, whether geopolitical flux, war, the return of inflation and rising interest rates, market volatility, market players probably would have been excused for having focused in the last several months on business resilience and adaptation, as opposed to the relative competitiveness of financial services. And yet, financial services competitiveness and competitiveness at large are a hot topic, and perhaps nowhere more so than in Brussels. No fewer than two former Italian prime ministers have been tasked with looking into the matter, with Enrico Letta having been requested by the incoming Belgian presidency to consider the future of the European single market, and Mario Draghi having been asked by Commission President von der Leyen to produce a report on European competitiveness more broadly. Indeed, in financial services, Europe, and not just the EU, has lagged behind since the global financial crisis, not just in comparative terms, but also in key industry sectors. European banking market cap fell, in fact, from $2.7 trillion to $1.4 trillion in the period between 2007 and 2021, while US banking market cap rose from $1.6 to $2.6 trillion in the same period. In 2007, the European share of the fund management wallet of the top 100 investment firms sat at 47%. In 2022, it was at a mere 22%. But the story is not all doom and gloom. Europe, and the EU particularly, has made strides in the likes of sustainable finance and in the digital financial services revolution. In parallel, the ultimate prospect of a more cohesive capital markets union and a completed banking union do offer some hope of accelerating Europe's potential as a financial services pioneer to the benefit of its competitive and economic edge. So, how did we get here, and what are the reasons behind these trends that we've seen of the last 10 to 15 years? And most importantly, what opportunities are ripe for the picking in terms of the future of European financial services competitiveness? Well, to answer these questions and more, I'm very pleased to be joined by a formidable lineup of speakers from business, policy, and advisory. And without further ado, I'll turn to our first guest of the day. I'm pleased to be joined now by Clive Horwood, who is Managing Editor and Deputy CEO of OMFIF, the official Monetary and Financial Institutions Forum. It's very timely, as on the 11th of January this year, OMFIF published a report commissioned by Luxembourg for Finance on the future competitiveness of European financial services. Clive, welcome.
Hi Simon, nice to be here.
Good to have you here. So where to begin? Competition and competitiveness, it's the talk of the town and certainly the talk of Europe at the moment. But Europe hasn't looked too rosy over the last 10 to 15 years, has it? Paint us a picture, if you will, of the current state of play here for financial services. What have you seen? And I assume it's not as simple as weak economic performance, is it?
No, it's not. But Simon, first of all, I should say thank you to Luxembourg for Finance for partnering with us on this report. As you say, the timing is fantastic. There is such a focus now on this issue of competitiveness, and financial services are so crucial to Europe's future. So the timing has been great. It's been a super project to get involved in. I think we can discuss today some very interesting data and findings that came out of the report. You're right. Competitiveness, first of all, how do we define it? For our purposes, and it's not easy to define it in the concept of financial services, but it's about scale, it's about diversification, it's about profitability, it's about influence as well, and about being ready to finance the areas of an economy that really need to be financed. You mentioned, I think, in your opening remarks, some of the overall numbers in terms of the banking and asset management industries. If we just take a step back on that for a second, now there are just 2 EU-headquartered banks amongst the top 20 banks in the world by market capitalisation. Now there are just 2 EU-headquartered asset managers amongst the top 20 asset managers in the world by assets under management. So we can see the decline of Europe over the last 15 years. I'm sure we'll go in over the course of the next few minutes into some of the reasons for that. But we do think, and the report does find, that there is an opportunity now for Europe to reverse some of those losses. If we take the asset management industry, for example, if we look at somewhere like BlackRock, I mean, BlackRock is by far the biggest asset manager in the world now. It's easy to forget that the transformative deal for BlackRock was actually to buy iShares from Barclays, which is a European bank. So while we might think at the moment that the leadership, say, of the US banks is entrenched and that JP Morgan is turning out 49 billion of profits, they announced last week, and the most profitable of the European banks comes in around 10 or 12, that the market cap of the 4 biggest banks in the 4 biggest economies in Europe is less than half of that of JP Morgan. And one might think that's an insurmountable gap to make up, and maybe it will be. But I'm old enough to remember when the Japanese banks were the dominating force in world banking in the 80s and 90s. And I think if we go back to 2007, this was very much a level playing field. I can remember actually sitting down with the head of one European bank in 2007, who was telling me that as the global financial crisis was first hitting in the US, that this was the opportunity for European banks to actually take over and become the world leaders. It didn't pan out that way for various reasons that we can discuss. But certainly, nothing is set in stone in financial markets and financial services.
Sure. And can we delve a bit into the reasons behind this? One of the things that I don't think we can avoid talking about is market fragmentation in the context of regional competitiveness. Europe, by its nature, doesn't quite behave in the same way as the likes of the US, China. Despite a level of harmonization, it is a land of disparate legal and fiscal regimes. What does that mean for the likes of asset management and banking, and what do you think is needed to make progress here?
I think it's where you said in your first question, you mentioned the economic performance, and I think it's worth noting that. I mean, there's no doubt that banks, financial services, asset managers thrive in better economies, and whereas I think in 2013, the total GDP of the EU was about 91% of the US. Now it's under 70. So that has an impact. The main US stock market index, the MSCI, has risen by over 200% over that 10 years, whereas Europe has risen by 30. So there are macro factors here beyond the control of regulators or the institutions themselves that have held Europe back. So I think it's important to bear that in mind. Let's think about this sort of like, how do you solve the fragmentation issue? I think we all know the fragmentation issue is so important. Nicoletta Merkel, your CEO, mentions it very eloquently in the foreword to the report, that if we don't solve the fragmentation issue, these problems will linger. The fact that we talk about cross-border in itself within Europe, I think, tells a story. We're not talking about within Europe integration. We're still thinking about a cross-border merger of banks or asset managers. So that tells you that the national identities still remain important. And then the fragmentation can be shown in other ways. So for example, if you take someone like Crédit Agricole, I think it has the largest deposit base of any bank in Europe, and it has 27% of the deposits in France. But it's only 4% of the deposits across the EU. If you look at Bank of America and JP Morgan, they're more like 14, 15% of the total deposit base in the US, which, as we've just said, is a much larger economy. So these issues of fragmentation need to be dealt with. Now, we all know that at the heart of this will be achieving a capital markets union and a banking union. I don't think we can speculate too much on that today, and a lot of effort has gone into that as well. But we can look at how national laws are still conflicting sometimes with EU laws. So the national laws on tax, on clearing, they differ between countries. We can talk about still the need in many countries feel they need to have national champions rather than thinking about European champions, which I think is a really important point. And I think we've can also talk about a little bit still, but in the same way about home bias. If you look at Amundi is a very successful organisation. It's it's an agglomeration of fund managers, obviously with a French headquarter, but has achieved scale on a real global level. 46% of its assets, of its investments, are still in France. So I think this tells us that the fragmentation issue needs to be solved. Banking and Capital Markets Union are the key ones to that, but there may be some things that can be done in the meantime to actually start to move things forward.
And isn't it also a question of risk appetite? I think we'd probably struggle to put Europe, the US, Asia in the same basket in terms of investor risk appetite, probably also supervisory risk appetite. What have you seen in that respect? And do you think we're at a point now where the landscape might change, whether that's through technology, democratization, other developments? And maybe as a follow-up question, if you don't think that's going to change, are there other options, for example, mobilizing capital and savings?
Yes, it's a really important point. It's a cliche, but all cliches have some root in reality. The culture of the risk-averse European investor, whether it's on a retail side, whether it's on an institutional side. We mentioned home bias before. That's all part of the lack of risk culture. Certainly the US and the Asian markets feel like they are much more investment cultures that embrace risk. I think it's worth looking at sort of the background to this a little bit. If you look at, say, a retail investor, a sophisticated retail investor who maybe is diversifying into corporate bonds, at this stage, if I'm a German sophisticated high net worth investor, I'm still probably much more likely to buy a corporate bond from E.ON if I wanted exposure to the energy sector than I would do an EDF one, for example. I think that we're in a slightly chicken and egg situation here. I think Europe can learn something in its pensions industry. I think the 401k, which we don't need to go into the details of now, but the 401k system in the US promotes risk-taking. It promotes building a diversified portfolio of assets. I think the European, still reliant on largely defined benefit pensions rather than defined contribution, holds that back somewhat. I think it's worth looking at the underlying markets here and the risk culture across financial services as well. I mean, we know that 44% of mortgage loans are on bank balances in Europe, whereas in the US it's more like 10 to 15%. We know that 90% of household financing in Europe is done by banks, where 3/4 is financing capital markets in the US. We know that 80% of corporate loans in the US are funded by capital markets, whereas it's more like 30% in Europe. So there is a need, and these things don't happen overnight, there is a need to change the risk culture in Europe. And I think this is being grasped actually by Europe, by the EU, by the Commission, and by European regulators. We're seeing the attempt to create some pan-European investment products that maybe allow you to take more risk. So we've seen the pan-European personal pension product, and we've seen the European long-term investment funds, for example, starting. They're in their early days, but they show that there is a desire to move these things forward. We see it also in trying to create sort of more investment cultures through sovereign bonds. We've seen Belgium do a 20 billion sovereign bond last year. We've actually seen Hungary do one as well, which has a lower risk culture and a much smaller investor base than someone like Belgium. So signs of movement are there. Just to take another step, just looking at it, if we think about risk, we have to think these days in global terms about private equity. Now, private equity, there are many good private equity firms in Europe doing a really good job. But do we think there are any at the moment on the scale of, say, a KKR and a Blackstone? No. Could that change? Perhaps. Let's see.
So signs of movement there, though.
Yes.
And we've touched on it already, but can we focus for a moment on regulation? We've obviously seen a significant influx of regulation since the global financial crisis. I think it's probably rather too easy to point a finger at regulation as the brake on competitiveness. But how has regulation affected financial services? I think the US, Asia, Europe haven't quite experienced it in the same way, have they?
No, the attempts to create a level playing field in financial services globally have singularly failed, I think, to date. And it feels like, so in the last 10 years or so, Europe has borne the brunt of that. So if we look at the banking industry in particular, 10 years ago, the levels of Tier 1 capital held by banks in the US and Europe were roughly the same. Now, European banks will generally have 3% more Tier 1 capital than their US counterparts. There are a number of reasons for that we go into the report. on. I think one of the really interesting ones is what they call the management buffer, and this is the excess capital you choose to hold as a bank. You're not forced to, but you choose to because you're worried that you might need to raise capital or there might be a change in regulations. European banks on average hold about 4% in that management buffer. US banks about 1.9%. This is it's important for European banks because the valuation of European banks at the moment is still very low, so they don't want to be in a position where they have to go out and raise capital because they're going to be doing it at very uneconomic rates. Equally, though, some banks have complained about the need to create a sort of a single resolution fund, and that they're paying quite a lot of money into building up this single resolution fund. But actually, some of that management buffer is about trust. And one of the things that actually European banks need to do is regain the trust of the international investors. You can see it again in those low valuations. The international investment community doesn't apply the same value to the businesses of the big European banks than they do to the US. And part of that is understanding that in a stress situation, and we saw a few of those last year, and we saw them in the US, and they were handled quite well. In a stress situation, you know the process through which the resolution might happen. So there is a change afoot, though. The US banks are being faced with some new regulations, what they call now the Basel III endgame, which will probably see them having to raise their capital levels by about the same amount as the gap at the moment. So the playing field is getting more level. The European banks, I think, would argue, make it easier for us, but at least the playing field is becoming a little bit leveled in that respect.
It's levelling as the US is going to
That's right.
catch up.
Yes.
Yeah. You mentioned in the report a couple of areas where you view Europe as having excelled. EU in particular has shown its credentials in sustainable finance. You also mentioned digital. What does the future hold, do you think, in that sense, and how does Europe secure the status of trailblazer as opposed to outlier?
Yeah, I mean, certainly in green finance, OMFIF, we do events around the world, and we do quite a lot in the green and transition finance space, and all eyes are on Europe at the moment. If you just look at something like the green bond market, you have the Next Gen EU borrowing program. They are the largest green bond issuer in the world. This is, and about 80% of green bonds are actually issued by European entities. So you can really see that, and the investors are looking at taxonomies that have been created in Europe as well as market leaders. So there's no doubt that Europe is in an advanced position compared to the US and Europe in that green finance side. Now, there will need to be continually releasing capital creating financial products to actually continue to do that. I mean, securitization is a great example of that. Securitization could be a great market for financing green loans, green car loans, anything that has an income stream from it. So that's one example. Europe doesn't at the moment still have that capital markets base. It needs to create that capital markets base to grow this. If we're going to finance 500 billion euros a year, I think, for the green transition. But the signs on that are very good. In technology and financial services, I think Europe is doing well. It should certainly do better. I mean, certainly the digital financial package that came out in 2020 hits all the right buttons. It still needs to be developed and it still needs to be incorporated. But in terms of hitting the right spots of tackling fragmentation, inspiring innovation, common data access and things like that, it really does actually sort of like provide a very good framework for the future. We've certainly seen Europe becoming a leader in data. GDPR caused a lot of friction when it came in, but data is so crucial to this technological and digital revolution that we're going through in all areas of our lives, including financial services. And Europe has created a really good playing field for that. It's certainly doing a lot of work in modernising the payment system across Europe. That's important, and banks have sometimes pushed back a little bit on some of the payment services directives because of the cost involved, but I think in the long term, this creates an important building block for financial services in Europe. And even in the areas such as central bank digital currencies, we see the ECB with a clearly set out 2-year program now as it starts to explore the potentials for CBDCs. It's working with a number of banks. So for example, we sometimes think of some of the Asian banks, particularly in places like Singapore, as being leaders in technology. I would counter and say that some of the Spanish banks have been for some time and continue to be. Santander's growth in retail, the previous chairman, Emilio Botín, always put it down to the fact they had this Parthenon platform, which was a global leader. This is how they became a great retail bank. Caixa Bank, in Spain also doing the same thing, and is the single bank involved in the ECB in their CBDC projects around sort of like pilot programs for retail CBDC. So Europe has a chance in both of these areas. It has, I think, a leadership in green and is certainly in the game in technology.
So we've covered a huge amount. You cover even more in the report. We've spoken already about regulation, about fragmentation, about capital markets union, banking union. Is there something that stands out to you as a parting thought, the one thing that we should take away from all of this?
Maybe more than one, if I may, Simon.
Absolutely.
First of all, get capital markets union, banking union done. I think we all know that. That's going to require a change, I think, or a greater political will than has existed so far. But the good news on that is I think it's starting to come, and we're really seeing it now with this European focus on competitiveness and competition. The fact that President von der Leyen has actually commissioned Mario Draghi to do a report on competitiveness. We have a report also being commissioned by the Belgian presidency of the EU with another former Italian PM letter looking at the internal market. And these are very much focused on let's make sure that Europe is competitive as it can be. I think we need a different regulatory approach. I think the regulatory approach, sometimes possibly inspired by politicians, is to see banks and financial services as a bit of a problem child that constantly needs to be supervised and berated and punished if it slightly underperforms or does something wrong. I look at Asia and the US, and one of the things I see there is they absolutely see that banks and asset managers are the key drivers of economic growth and innovation. And that is, so I would like to see that regulators would say, every time they're looking at a piece of regulation that applies to financial services, run it through the lens of whether this might actually have an effect on the competitiveness of the institutions that it's covering. I think that's really, really important. I think that level of trust that we talked about before in the financial services in Europe is coming back. That will come back as they are more profitable, and they're beginning to be now. You see banks now with returns on equity back to double digits as net interest margins rise. They need to use that opportunity. Equally, that opportunity, they need to make sure that they have the ability to actually give Europe what it needs. Now, if you look at the new profitability of the banking sector in Europe, where's the money going? It's being returned to shareholders in increased deposits, or it's being used to buy back shares to try to bring the share price back up to close to book value. That suggests that potentially they don't at the moment feel like they have the products, the services to invest in and to help Europe drive that economic growth. So I think this is a really good time for European financial services, the best it's been for at least 10 years. But the whole of that ecosystem needs to come together to make sure that the opportunity is taken and that Europe really does show leadership in areas of financial services again.
So some structural reform and also cultural reform, I think.
Cultural, structural, and yes, just the whole sense of what financial services are for.
Clive, thank you very much. There's a lot to digest there. The data is very revealing and the report's, of course, very timely. We're now going to turn to two of the areas mentioned in the report as areas of potential and to look at how those might be, alongside other efforts, vehicles to drive future success. So in the first panel, my colleague Benoit Theunissen is going to look at sustainability as a strategy.
Welcome everybody to our panel discussion on sustainability as a strategy, the EU blueprint to elevate investor confidence. In the wake of the Paris Accord, the European Union has pioneered a regulatory framework for sustainable finance, which is crucial for achieving the goals of the European Green Deal. This approach, demanding an annual financial commitment of 620 billion euros from both public and private sectors, represents a paradigm shift in integrating sustainability into financial operations. Today, as we navigate through challenges and strategies of this framework, we will explore how the EU is leading the way in transforming financial services to address the urgent demands of climate change, guided by long-term goals and robust legislative support. And joining us today in the studio, I have Nicoletta Centofanti, You're the CEO of the Luxembourg Sustainable Finance Initiative, LSFI. You're a renowned environmental engineer and sustainability expert. Your extensive experience in CSR and sustainable finance has made you a key figure in guiding financial players towards greater sustainability and impact. Hello, Nicoletta, and thank you for being here.
Good morning, Benoit. Good morning, everyone. Thank you for having me today.
You're welcome. And joining Nicoletta remotely, directly from Brussels, we have Huhtaniemi. Hello, Hannes.
Good morning, Benoit. Good morning, Nicoletta.
So, Hannes, you lead the sustainable finance team at the European Commission's DG Fisma. Your experience in financial institutions resolution and securities markets regulation, combined with your focus on sustainable finance, offer us today a unique and comprehensive view on the evolving world of financial stability and environmental governance. So, thank you again to both of you for being here. And Hannes, I would like to start our discussion this morning with a question for you, which is, how does the EU's leadership and early adoption in establishing sustainable finance standards and taxonomy influence its competitiveness on the global stage?
Well, Benoit, as you said, the EU is indeed a first mover in this space. I think it's fair to say that the EU does have the most advanced framework when it comes to sustainable finance tools and measures in place, whether it's our EU taxonomy, so our classification system for activities which are considered to be environmentally sustainable, or our sustainability reporting requirements, and then going to other parts of the framework, such as our green bond standards or benchmarks. All of this is unique globally, as you said. Other jurisdictions have comparable elements, but not the full toolkit. But from our perspective, this is critical in order to help achieve the mobilization of those financial figures that you mentioned there at the top as well. Annual sums in the region of 620 billion. We know that private finance will have to contribute the lion's share of this amount. Public money will be nowhere near enough, and public money plays an important role in bridging investment gaps or leading, showing the direction of travel, but it cannot cover this full amount. So that's where sustainable finance comes in, and that's where we have put our efforts in ensuring that the toolkit that we have in place is proportionate and sufficiently ambitious to achieve these objectives. And from our perspective, there is no contradiction between sustainability in the long term and competitiveness, both in the medium and long term. In the future green digital economy, from our perspective, certainly this is something that we should absolutely continue to pursue in an ambitious and proportionate sense. And I think the first evidence that we see now in 2023, and we'll see what we see in 2024 of the reporting that we see from companies when it comes to how the markets have adopted these different tools. They are, broadly speaking, quite encouraging. So we are heartened by the fact that there does seem to be a shift in the mentality of companies and investors, not only because of our sustainable finance toolkit, obviously, but partially, hopefully, due to the measures that we have put in place, which are seeing funds increasingly mobilized towards activities which help decarbonization, help heal environmental degradation, and achieve this decoupling of economic performance from constant resource use. So as I said, we'll see how the figures that we see annually will corroborate the first signals that we saw last year, but certainly we have reasons to be hopeful that we're heading in the right direction.
Thank you very much, Hannes, for this first introductory answer. Nicoletta, I turn to you, and I would like to ask you, what impact does the European Union's comprehensive sustainable finance framework have on global investment trends, especially in terms of attracting international investors?
Thank you, Benoit, for this question and, of course, for having me. So I would like to start by looking at the figures, right? The Global Sustainable Investment Review 2022 that was issued last November speaks of $30.3 trillion of sustainable investments, whereby the global proportion of the European investments grew from the last publication to the current one, so in 2 years, from 34% up to 46% of these global invested sustainable assets. And looking at, again, the figures by the end of 2021, Europe dominated the sustainable investment space, accounting for almost 80% of Q4 inflows and continuously developing products and launching new funds. So as Hannes also said, but here is the review that speaks about that, the EU Sustainable Finance Action Plan and the whole suites of accompanying regulation and legislation is considered arguably the most comprehensive of any region or country in the past 10 years. And of course, the EU Commission with all this package is basically signaling investors the direction that the EU is taking regarding to how assets should be invested and how the real economy should transition. So going back, let's say, to your question, global investors, international investors, also as mentioned in the OMFIF LFF report, where practitioners were interviewed, are looking at the EU as a hub for sustainable finance, where to look for knowledge in the space, for, let's say, the best methodologies, but also, as far as I understood, as the region where real sustainable investments in the long term are present. So this is a confirmation of the great work that has been done by the European Commission in this space.
Okay, thank you very much. That's very interesting insight. And now another question for both of you. But I will start with you, Hannes. Is the argument that there is overregulation in Europe any more than a perception? If so, what potential challenges does this create in the field of sustainable finance?
Well, I would say that whether or not it's purely a perception or something more concrete, we in any case have listened to all the concerns, criticisms very carefully and very seriously to understand where the potential bottlenecks, or frictions, or difficulties may lie. We continue to be in constant dialogue with the markets to get a better understanding of these problems in order to ensure that the uptake of our toolkit is as efficient and effective as possible. And we've already announced a few steps last year, and this work will continue under the next Commission, to help clarify and to make more proportionate aspects of the framework where it has been shown that some actors are finding it difficult to use the tools or comply with the rules. So just to mention some of the work that we have begun in this space, for example, last summer we adopted a recommendation on transition finance, and this very much in recognition of the fact that some have argued that our taxonomy, for example, is too binary. It focuses too much, they say, on what is already green, whereas large parts of the economy, in fact, the majority of our economy still is at earlier stages of the transition and have not reached that high level of green yet. So this transition finance recommendation is just an example of a step that we have taken to explore principles, ideas, and recommendations for the markets and for authorities as well in helping companies and financial actors chart a path regardless of their starting points towards more sustainable practices. We also announced certain adjustments, for example, to the European Sustainability Reporting Standards, and this as regards the possibility for actors to always assess whether or not something is material in their case as part of those disclosures. And also this was in June as well. And then in September, we announced as part of a SME relief package that certain steps will continue to be explored specifically for SMEs to help them also take up the tools of the framework. And as part of this, we're exploring ways to make the rules more proportionate, more adapted to their specific circumstances. And this will continue throughout this year and into the next Commission, which is due to take up office at the end of this year. So this, together with all of the other implementation guidance which we continue to offer, whether it's in the shape of frequently asked questions on taxonomy or other user-friendly tools which we try to put at the disposal of market operators in that regard, or upcoming guidance which is foreseen for the implementation of the European Sustainability Reporting Standards. Together with these steps, we hope to make sure that we are addressing these criticisms expressed by some in the markets and helping them also take advantage of the framework and hopefully to dispel any concerns that they may have expressed about their continued access to finance.
Thanks. Nicoletta, is there anything you would like to quickly add to what Hannes just said?
Yeah, you know, I would like to put myself in the shoes of the European Commission and to try to explain why this whole comprehensive and complete architecture may seem overwhelming sometimes from the point of view of the market. Of course, the European Commission has decided to embark in a very complete framework, trying to regulate what I like to refer to as the flow of capital, right? We have three actors. I'm simplifying it very much for the audience and for the sake of timing. We have companies and projects. We have the whole suite of financial market participants and sectors, and we have ultimately institutional investors and retail investors and savers. And the European Commission has tried to regulate the different actors and the relationship that they have with each other. And of course, this is not easy, and that is why there are so many different regulatory pieces, because all the different relationship has to be regulated by different, you know, pieces. And so there is an intrinsic structural, let's say, barrier, and that is why there were some challenges at the beginning, because market participants had to become acquainted with that. Of course, the fact that sometimes the timeline were not fully aligned, the definitions, let's say, were not fully aligned sometimes from time to time, posed a challenge for the market participant. But as Hannes explained, the European Commission has always been very attentive, very open, very listening to the market and trying to adjust as much as possible. The remaining challenges, of course, are now implementing, operationally executing the regulatory requirements, and therefore, as we said at the beginning, a full paradigm shift is required for the market practitioners, and therefore, you know, you need to implement those processes, acquire new skill set, new resources, possibly IT structures, and that's somehow a challenge. challenge because it requires effort and a full paradigm shift.
Okay. I would like to move on with another topic and continue with you. And maybe you can answer, how does stringent regulation impact innovation, particularly in emerging fields? And how does one achieve a balanced approach between regulatory compliance and also fostering innovation?
Well, I would like to, clarify what do we mean by innovation in that respect, right? You mentioned at the beginning the financing need for our economy to transition. And here, when you say that, I believe you're referring to industrial innovation, right? The shift that our real economy, different sectors needs to transition. When we consider innovation now, in the current sustainable finance regulatory space requirements, I do see a huge opportunity for the so-called fintech innovation. Luxembourg is a pioneer in the space, and just looking at Luxembourg in this year, 2024, two fintech accelerator will be launched by the Loft together with partners. So one specifically on the funding side, together with the ALFI, the Investment Fund Association, and one really focused on sustainable finance. Why I'm saying that is because it's true that more requirements are going to be put in place, but it's also true that there is room for innovation. Fintech innovation can help financial market participants be faster in implementing those requirements and reducing costs. So when we look at the regulation, I think stringent requirements may be, better to a certain extent, whereby I believe that the European Commission has set up stringent requirements when it comes to companies' disclosure. When we speak about KPIs, that has to be defined and therefore harmonized and comparable. For other type of regulation, the European Commission has simply tried to enhance and foster transparency and provide a level playing field for the practitioner and ultimately to investors that have accessibility to a broader range of information to take informed decision.
Great. Hannes, from the policy side, do you have anything you would like to add to Nicoletta's answer?
I would perhaps mainly just add that many parts of our framework are voluntary. There is no obligation for markets to perform in accordance, for example, with the criteria of the taxonomy. As Nicoletta mentioned, what is mandatory are the disclosures related to environmental performance levels. But we do see that there is some positive impact from having, for example, a new voluntary standard in place through the taxonomy when it comes to innovative new technology sectors. For example, there are some signals that these new criteria set by the taxonomy are now considered by many in the markets to be those that they do want to strive for and to report accordingly on. So yeah, in this tussle between regulation and innovation, I think that, for example, our taxonomy is showing some good promise in that regard.
You also mentioned earlier in our discussion some challenges in the sustainable finance regulatory agenda. Can you quickly discuss about these critical gaps, and are there any outstanding areas that still need to be fulfilled?
Yes, absolutely. So while it is the case that most of the elements of our framework are in place now, since the launch of those action plans and strategies, which Nicoletta also referred to, there are still aspects on which we need to continue to work on. And I mentioned some of them already, for example, to do with a more inclusive framework for transition finance. This is something that we will continue to explore. Also, making the rulebook more proportionate, adjusted specifically for SMEs and households. so that they also can participate fully in the opportunities of the green transition and of the rule book that we have in place. And this is something that we will continue to explore under the next Commission in many ways. Other aspects, which I think Nicoletta also alluded to there, have to do with making data, which we have currently required of companies, these KPIs, key performance indicators, making all of that more comparable, more usable for investors. And here, for example, machine readability of that data becomes important, so that the value chain from companies to investors works as we would hope, and that investors are able to make informed choices and decisions based on the best available data. Our framework will continue to evolve, is how I would summarize it. Whether it's adding new activities to the taxonomy, for example, mining of critical raw materials, that's something which remains an important element, which is currently not yet included in that framework. That's something that is being looked at as a priority by the experts that advise the Commission. And then these other tools, which I mentioned, for example, to make the framework more inclusive, more proportionate for SMEs and households, and so on.
Yeah, so the job is not yet done. Nicoletta, in what ways do Europe's measures against greenwashing support the strength of its sustainable finance sector? Can or should this approach be exported to other regions? What's your view on that?
Well, I would like, to first refer to the non-binding definition that the ESMA has put in its Sustainable Finance Roadmap, right? Because it's important to clarify what do we mean by greenwashing. So here in the Sustainable Finance Roadmap, greenwashing is identified as a phenomenon of misrepresentation, mislabeling, mis-selling, and or mispricing. And again, I will a bit repeat myself, but considering that the Sustainable Finance Framework set up by the European Commission alludes to greenwashing, particularly in the taxonomy and in the Sustainable Finance Disclosure Regulation, SFDR, enhancing transparency and disclosure prevents greenwashing, because the more information we provide to the ultimate end user, which is the investors, the more we provide a level playing field that allows to have access to the information that are needed, and then ultimately the investor can take informed decision, and therefore the ultimate objective is to prevent greenwashing. And I believe there's no need to say that this practice should be definitely exported, and I'm sure the European Commission, with all its exchanges with the other international bodies, is trying to make sure that transparency and the same harmonized and standardized practice are applicable elsewhere in the world, to make sure that the more information we provide, the better informed decision anyone can take when investing, and therefore greenwashing practices can be prevented as well.
Thank you. And now I would like to move on to our final questions, and that I would like to ask to both of you, which is, how can Europe's sustainable finance sector remain strong despite challenges such as differing regulatory approaches across regions of the world, and also inconsistencies or uncertainties in public perception and understanding? So maybe to answer these questions, I would like to turn myself to Brussels and ask you, Hannes, your view on the question.
Yes, as we started the discussion this morning, we said that the EU framework is indeed the most advanced, and answers to and speaks to specificities of our single market in the EU. Now, obviously, improving international comparability and interoperability where possible of the rules between different jurisdictions is absolutely critical. We are first movers, but many others have adopted similar steps. And knowledge and best practices are being discussed and shared in international fora such as the G20, the Financial Stability Board, the International Platform on Sustainable Finance, etc. And this very much with a view to improving, as I said, comparability and interoperability between the different frameworks. This work is ongoing. It's in many cases still in early stages, and this is something that we will have to continue to explore, obviously, in order to make sure that the toolkit, globally speaking, works as effectively as we all hope. Obviously, in Europe, we don't necessarily, at the European level, we don't have access to all of the tools that some other jurisdictions have on helping to influence outcomes through, for example, taxation or direct subsidies. But that's not to say that the EU hasn't taken steps in this space as well, for example, with the Recovery and Resilience Facility funding options available, and the Net Zero Industry Act, which was adopted last year to help further boost the EU's competitiveness. So while many of these levers are in the control of member states, there's still a vital role that the EU can play in coordinating many of these steps and in providing some of that public funding, which I mentioned is key to help bridge some of the investment gaps. And just to say that all of these steps, whether it's these Net Zero Industry Act actions or sustainable finance actions, are always done in a very carefully calibrated way to make sure that they sustain, support, and promote the EU's competitiveness and remain proportionate to the objectives.
Thanks. And the final word to these questions is for you, Nicoletta.
Thank you, Benoit. Well, I'll echo some of the points mentioned by Hannes, but I would underline that I would hope that the European Commission continue provide the right policy signals, so continuing putting the accent on the framework that has been developed and making sure it is constantly up to date. We know, for example, that the taxonomy refers to the best available technologies. This will require constant update by the team and the expert involved in the process. A supportive policy framework needs to be continuously enriched and somehow executed. Hannes mentioned a few adjustments that will be required over the years, and I'm sure that for a while the European Commission will have to be busy listening to the market, adjusting the framework and integrating the pieces that will be needed to be further strengthened that are now not for a priority for the time being. And then, of course, strengthening investment opportunities. So I mentioned industrial innovation, a lot of investment support, subsidies, relief in taxation is needed there, as well as I would hope that so in the sustainable finance domain, incentives are provided to the so-called best practitioner, because it's true that we need to incentivize let's say the sector that has to transition, but somehow it would be nice to see some rewards for the ones that are first mover, that are taking the cost on their shoulders because they are really committed in the space and they really believe it's a long-term forward for finance. And yes, to conclude, I'll hope that there will be still a lot of accent on the impact of sustainable finance, because ultimately, if we really want to have our economy to transition, sustainable finance has to deliver a positive impact on our economies. These are my wishes.
That's a very good conclusion. I would like to thank you, both of you, Nicoletta and Hannes, for participating to our panel, and I'm looking forward to hearing from the other panels of this event. Thank you very much. Bye.
Thank you, Benoit. For our next panel, we're going to be looking at the digital financial journey to unpick the extent to which regulatory maturity is in sync with firms' own readiness, and also to look at the extent to which Europe is positioning itself as a leader in this field. And I'm very pleased to be joined now by Anthony Wolff. Anthony is Head of Financial Services at SIA Partners. Anthony, welcome.
Thank you, Simon, for this invitation.
Good to have you with us. Let's dig in straight away and perhaps start with some context. It would be interesting to hear your view on where you think Europe stands at the moment in terms of digital readiness from a regulatory perspective. And also if you have views on a jurisdictional comparison, say Europe versus US, Asia.
Yes, actually, the European Union has always been active in implementing regulation related to digital services, data protection, cybersecurity, but also competition. If I take an example, the GDPR regulation, which is General Data Protection, implemented in 2018, it's a good example and a significant European regulation that focuses on protecting the privacy and the personal data of individuals. Also, the EU Union has been working on Digital Service Act, DSA, and the Digital Market Act, which aims to regulate digital platforms in regards of competition and protection of the user's right. And more recently, they're also working on the regulation around artificial intelligence. If we compare it to American, there is no unified regulation for the whole country. Actually, everything is divided by states. So there can be big differences from one state to the other. If we take an example from one of the most advanced states, which is California, they have this California Customer Privacy Act, which is also inspired by GDPR, and the target of that is also to protect their data. They have a lot of regulation around antitrust also, because, as you know, most of the biggest tech companies are based in California. If we compare it to the Asian market, and when we speak about Asia, it's of course mainly China. The regulation is mostly around control on the content, internet content, but also around data localization and cybersecurity. The other countries around China, like Singapore, Taiwan, South Korea, Japan, they are starting to implement regulation about data protection.
And if we come back to Europe and keep as this background global competitiveness, we've heard already how the EU has taken the lead in sustainable finance, forging a path for financial services through being a form of regulatory pioneer. Is there a similar case for bolstering the relative performance of key sectors, whether asset management, banking, insurance, through regulation in the digital space? And if you think that is the case, what do you think are the areas under the heading of digital that are most ripe for this?
Well, actually, when we talk about sustainability, the European Union has always been in the forefront of integrating these points in the regulation, and mostly in the financial sector through regulatory initiatives. We can talk about the CSRD and the impact it has for a financial institution, for which they actually need to communicate on their goals and targets around sustainability. What are they really doing for sustainability? And this will be interesting because they need to publish this report, and in a few years it will be easy for anyone to compare what they've been communicating with what they actually have achieved. And based on that, we will be able to identify which companies are doing some greenwashings and which companies are actually really investing on that topic.
We often hear about the twin transition, sustainability, digital. We hear about them spoken in parallel. Of course, they're very much interconnected. Picking up on a few things that you've spoken about just now, to what extent do you see the one accelerating the other, whether it's sustainability to digital or vice versa?
Actually, it's going both ways. We see that today a lot of fintechs are proposing solutions for the financial institution to increase the communication that they can do to their client. We're talking about retail clients, but also professional clients or asset managers around credit, investment, insurance, if I can give you an example, you have this company, Greenly, which is proposing actually to analyze what is your carbon footprint based on the way you spend your money. So anyone can use it. First, retail clients, but also the professional clients that want to actually reduce their carbon footprint. They can use this kind of solution. They can just plug to them with their current account with simple API. And they will have a clear view on which action they can take to improve that. The banks are also developing their own solution and also trying to be greener in the way they propose new products. So we see that in the investment worlds now a lot of banks are proposing a grid in which you can really see if I invest in that or that other product, what will be my impact. Talking about sustainability, if you talk about insurance, the fact of taking an insurance for an electric car or a classical car won't be the same, and you might have some better conditions for an electric cars because usually drivers having an electric car are driving more carefully. That's just an example. Huh? On credit also, if you want to buy a house, we see that actually the market today, the houses which have a better isolation for which are more sustainable, you can actually get better conditions because the banks actually knows that the sell price of these houses will be higher in the future than the old houses with no isolation. And we can go on like that on a lot of products. So all these solutions are today proposed by the leaders, the digital leaders on the market to be able to make the link between the service I need and the sustainable vision of that service, the sustainable impact. Yes, that's there is actually a link between both.
So is that to say that you see firms' own readiness? I mean, the opportunities are certainly there, but firms' own readiness, they are keeping pace with regulation at the moment?
Yes, absolutely. So regulation is needed. It's needed because actually most of them, the financial company, they want to go and to move in that way because they realize that actually it's a global trend on that. But when there is a regulation, it's clearer in which path they need to take and in which way they need to go. And also it has an impact on competition because a lot of companies are always looking a bit what the others are doing and how far they need to go. And we always need to find a good balance between regulation or new rules, new restrictions sometimes, and commercial opportunities. So finding this good balance, it's easier when there is a clear regulation.
Mm-hmm. And in that sense, one of the topics that sometimes comes up is fragmentation from a European perspective. If we take some of the in-flight pieces of regulation or topics and look at the likes of PSD2, PSD3, Common Digital Space, how significant are these in terms of driving European financial services competitiveness? And can they contribute to alleviating some of that fragmentation that has tended to hold Europe back?
Actually, the concept of a common digital space in Europe is aligned with the broader goal of creating a digital single market. Actually, the DSM aims to remove the barrier to digital trade and promote seamless online environment for business and customer across the European Union member states. A common digital space, cross-border transaction, e-commerce, and the provision of digital services. It can contribute to the competitiveness in the European financial market, and this will make Europe more innovative because you can see that there is a big gap between countries, and some countries are more digitalized and more advanced than others. And then if we can have a European regulation like PSD2 that you mentioned, PSD3, which is coming, and people being able to compare these services from one country to the other, we will see that actually the quality of the digital services will improve.
And if we look at, and you've mentioned AI already, and so I pick on it here, the way in which regulation is put together. In December, the EU Parliament and Council negotiators reached a preliminary agreement on the Artificial Intelligence Act. And for a lot of people, that raises the question of the extent to which the balance is being maintained between, on the one hand, consumer protection, security, regulation, and on the other hand, innovation. What's your take on that, and how do we make sure that we strike the balance between those?
Regulation is needed. We can clearly see it, and I think that there is mostly a global agreement on that. Even with the big leaders around artificial intelligence, when they communicate, they say we need to put in place a regulation, because artificial intelligence is a wonderful tool and gives incredible possibilities and will completely change our way of living, our way of working, and our relationship with our technical environment. But it's also a risk. And today, we can see that a lot of companies in the financial industry, but also in other industries, are starting to look how they can use artificial intelligence and how they can implement artificial intelligence within their services. But it will always be easier to apply a regulation from start than waiting that people will develop solution, implement this solution, and then maybe in a few years say, we need to put in regulation. Then these companies, they might have to take a step back. And when you have so big investments, it's always quite a risk. So my personal opinion is that we need to find a good balance between regulation and development. This is the role of the regulator, but they also need to listen to the market. They also need to communicate with the big players in the artificial intelligence industry and try to find a common ground where Europe could actually find the perfect balance between innovation and data protection.
Mm-hmm. So pragmatism is important, but clarity also, and from your perspective, then a competitive edge lies therein.
Yes, absolutely. So we need clarity today. We know that sometimes in Europe, topics, they can take time. Artificial intelligence, the real jump of the artificial intelligence is quite recent, so it was a bit more than 1 year ago, but everybody is working it. So CR Partners has its own solution, which is CR GPT. We are proposing it to the client, and we are actually trying to find this good balance between all these elements. But regulators should move fast, so then the financial institution will be able to understand exactly what they can do, how they can do, and how they can mitigate the risk around the usage of artificial intelligence. If there is a gap between Europe and other locations, that's not really a problem. We know that today there is a big gap in data protection between Europe and China, and that's not a problem. Actually, we just have different mentalities and a different way of seeing that topic. So every region needs to move on its own path, trying to respect the goals of the main European companies and the goals of our client.
Well, Anthony, thank you very much for this overview and also this on-the-ground view of how this field is taking shape.
Thank you, Simon.
The stakes are high in terms of European financial services competitiveness, and there are clear signs that Europe has indeed lost ground. 2024 is going to be very interesting, not only in terms of the evolving geopolitical and market situation, and also the influx of regulatory initiatives, but also as a transition year, with European parliamentary elections taking place in June, the first since Brexit took effect, and a new commission taking the stage. As Ursula von der Leyen said in her State of the Union address last September, Europe will do whatever it takes to keep its competitive edge. Will we see a return to pre-financial crisis prominence? Well, that remains to be seen. But as we've heard from our speakers today in financial services, the tools are apparently there. So I'd like to thank our excellent speakers today and also thank you, the viewers, for tuning in. And we look forward to welcoming you to our next live stream, which will be a focus on long-term investing. Until then.